Great, welcome you all once again to the continuation of the IAS system. We are kicking it from where we ended our last meeting. Now, last meeting, we looked at the recognition of PPE, and then we said that PPEs are recognized. So let's see, IAS 16 bracket PPE, no shortcut. We said that recognition of PPEs are recognized in the financial statement as what non-current asset. That is as an asset. If two conditions were in place, we look at the condition. First condition talks about probable that future economic benefit will flow to the entity. And then the second condition, the cost of the PPE can be measured reliably. Those are the conditions. Now we explain some recognition of few items, and then how it must be treated. The first one I'll talk about is complex assets or component depreciation. It's still under the recognition. Complex assets. So complex assets. Just a summary, then we start solving questions. Now, when you talk about complex assets, is the asset that have components which the useful life of the components are different from the main asset. Great. Okay, so complex assets are assets that have components or parts such that each of the parts have a different useful life. Good. That is the complex assets. How do you recognize them in the books? How do you treat them in the books, especially the measurement? So let's give example of complex assets. Let's say airplane or aircraft. So example, aircraft. Now, if you take aircraft for instance, let's look at the body. So the components are, so assume that a company acquired aircraft at the cost of $125 billion. So that's the total cost of the aircraft. But this is a breakdown, the composition. The exterior body, and then let's put cost here, and let's put useful life. Let's put useful life here. Okay, so the exterior body, the cost brackets in dollars and millions. That is $45 million. Then we have the interior deco. Also, the cost is $25. So making $70. Making $70. Then engines. Let's say there are two. Let's assume that the engines are two. So each, so probably love it. The remaining amount is for engines. So if this is 70, 50, so that's 55. The total cost is $55 million. Now let's estimate the useful life of the engines. The useful life, let's assume that the exterior body will last for 20 years. The interior deco is going for 15 years. The engine will fly, all of them total, they'll fly for 6,000 hours. 6,000 hours. So 6,000 hours. Now, this is an example of what complex asset. How do you treat it in your book? So the standard is saying that we record the asset at what 125, but when we are calculating depreciation, we should calculate it what componently or separately. So separate depreciation. Why? Because the useful life of the assets, it's here. I go to select 20 years or 15 years or even 6,000 hours. No. So depreciate them componently or separately. So part by part. All what you have to do is in calculating of depreciation, extra body will be the 45 million all divided by what 20 years in that order. Deco 25 million over what 15 years. So that is a recognition of what complex asset. The standard is saying that it must be treated separately, even though their total cost is what 125. So depreciation will be based on individual parts or components. That is all. If you want to find the depreciation for the first year, they should tell us the number of hours that they've fly the engine. So maybe for the first year, 400 hours. With 400 hours, after we get the depreciation per hour, we multiply by about 400 to get the total depreciation charge for the first year in respect of for the engine. So basically, that is the component depreciation. Second, anytime you incur subsequent expenditure on this one, kindly capitalize to the specific component. So if you acquire new engine, kindly add it to the cost of the engine. Don't come and add it to the body. And depreciate it separately on the number of hours or the useful life. That's all. I'm done with the component depreciation. But right after depreciation, the asset is one. The asset is 125 million. That's all. It's only when you are depreciating it that is where you have to separate it, or that is where you have to now depreciate them separately, or we have what we call component depreciation. You depreciate component by component. So each component and its own depreciation. It's only when you are doing depreciating what the asset. At the end of the day, you sum all the depreciation together and get a total depreciation charge. You take it from the asset value together what the current value. That is all. Then I'll look at the second aspect of the major overhaul. Now, the second aspect is the major overhaul. We are done with the complex assets. So let's go to major overhaul. Treatment of major overhaul at a regular interval. Major overhaul. Okay. Now let's see what we call major overhaul. Major overhaul. The treatment of major overhaul. You know, some of the assets require regular or routine major overhaul to just boost or enhance the performance of the particular asset. For instance, you buy aircraft supposed to perform major overhaul at least once every 3 years. So let's start the example here. You bought an asset. The cost of the asset is 20 million US dollars. So that's the cost of the asset. Now this asset required a major overhaul. A major overhaul. Major overhaul at a cost of $5 million every 5 years. So every 5 years, you need to perform a major overhaul to change or to enhance the performance of the asset. How do you treat this? How do you recognize the cost of the major overhaul Okay. Now let's assume that the life of this asset is 10 years, useful life. So with a useful life of what? Of 10 years, and then useful life is 10 years. Good. The useful life of the asset is 10 years. What is the accounting treatment? Here we are saying that the cost of the major overhaul at a regular interval should be treated as a component. So must be treated as what? Component, and depreciated accordingly. So all what you have to do is, for the first 5 years, they've not incurred it. No, they've not incurred the component cost. They've not incurred. They will get from year 5, year 5, year 10, year 15 going. So all what we are saying is this: from year 1 to year 5, depreciation will be we have to depreciate the cost on the 10-year period. So that will be 20 over 10, which is equal to Ghana city of what? 2 million. That is it. For the first 5 years, depreciation will be what? Just 2 million. Then from year 6 up to year 10, that is where they incurred additional 5 million. So it means that still depreciation will be 2 million plus the major overhaul. So you have to also depreciate. We call it amortized. You have to amortize the major overhaul over the life of what? Over the interval. So it will be 5 million out of what? 5 years. Agreed. And that will give us 1 million. So that means from year 6 going, the total depreciation will be 3 million for that particular asset. So in short, all what we are saying is this: anytime you incur a major overhaul at a regular interval, kindly treat the overhaul as a component and depreciate it over the interval. Some have a regular interval, some does not have a regular interval. So that is it. Just depreciate it over the life of the overhaul. So let me where's the case. Let's assume that the overhaul will be like this. The cost is 5 million. And the first one will be incurred when? So the cost is 5 million. But the first overhaul will be in year, let's say, year 4. The second one will be in year 10. So, year 10. The next one will be in year 20. Good. So this tells you that the life of the overhaul is the distance. So the first one, 5 million. That one, the number of years should be from year 4 up to year 10. How many years? So year 4 to year 10. So don't fish out to count your fingers. So year 4, 1. Year 4, 1. Year 5, year 6, year 7, year 8, year 9, and year what? 10. So how many years? 7 solid years. So it's over 7. Take notes. Then from year 10 to 20, so that's 10 years. So that means this after the 11th on, the next one will last for when? 20. They will incur the next one on year 20. So in short, the interval between this is what? 10 years. That is all. So all what I'm saying is this: until the next one, some of them, they have a regular interval every 5 years. So that one, their life is 5. But where it does not have a regular interval, the life. So the first one will last for how many years? Until the next one. So the interval here and the interval here becomes the life. That's all. We are done with recognition of what? PPE. Let's go to the measurement of PPE. How do you measure PPE? How do you measure PPE? How do you measure PPE? And then there's a particular PPE that we have to talk about. A particular PPE that we have to talk about. A specific example. So let's talk about this particular PPE. Biological assets. So plants, or animal. So let's make it biological assets. Assets. This is an IAS 41 agriculture, which opposes inventory. IAS was 2, so they're in the same category. Now, plant or assets simple means asset that bear what? Fruit or brings offerings. So, example, we have plants. So, examples include plants. And that's example 1. Example 2, we have what? Animal. Yes, like cattle. Those assets, they are not for sale. They are just there to produce new products each and every day. So example of plant include what? Grapes, cocoa, oil palm, cashew. All these ones are what? Plants. These plants, they are aimed to produce what? Fruits or harvest for sale. We rather sell the harvest. We don't sell the plant itself. And we have the animal, as usual, like cattle, that we rear them, like goats and other animals that we can crop. Now, how do you treat them? However, even though they are under IAS 41, agriculture or biological assets, they are PPE. So assets are what? They are PPE. So they are classified as what? PPE. They are classified as PPE. So take note that PPE include what? Plant and what? Animal. So any plant that you, like cocoa farm, you have 10 acres of cocoa farm, the cost of the plant itself can be treated as what? PPE. It must be treated as PPE. However, the standard makes it clear that the fruits or the harvest or the produce of this asset, that one you have to classify it under what? Agricultural produce, or we use IAS 41 to account for it. So the plant itself is under IAS 16. So the plant is under what? IAS 16. But the produce, the harvest, the offering, that one is under what? So the produce is under IAS 41. So that one use the requirement of IAS 41 to account for it. So let's take note of that. On that note, we are done with the recognition. How to record PPE. So don't forget that PPE include what? Plant. It includes plants. That's the plant and what? Animal. Great. Let's move on to the measurement of PPE. Measurement of PPE. How do you measure PPE? I don't know if this one, then we are done. Then we start solving our questions. So PPE. Measurement. Measurement simple means how to obtain what? Value. Value to be placed on the assets. That's the measurement. Now the IAS 16 prescribes 2 measurement bases. We have the initial measurement and subsequent measurements. So let's look at the initial measurement. Initial measurement of PPE is at cost. That's all. It's at cost. Initial measurement simple means if you acquire the PPE today, the first time you bought the PPE, maybe in June, the next reporting period is December, the next one. So the initial measurement simple means the first time acquisition. What's the value? We are saying that the first time acquisition should be the cost. But that we listed the items the terms that we should know. So what is cost? Now, cost simple means cash and cash equivalent and fair value of other consideration transfer to acquired what? The assets. That's the meaning of what? Cost. So cost simple means cash and cash what? Equivalent. So cash and what? Cash equivalent. Number two, fair value of what? Other consideration. Other what? Consideration. Maybe you exchange your old vehicle for another one or another PPE or another asset. So that's get a fair value of the old one. So cash and cash equivalent transfer to acquire an asset. That's the cost of PPE. Now the cost, we have the composition of what cost. So let's look at the composition of what cost of PPE. So if you acquired PPE, the cost that you incur. Now the standard gives the inclusion of the cost. The cost is made up of three. So we have one, the purchase cost, which also have a breakdown. I'll talk about it later. We have directly attributable cost, which also have a breakdown. Then we have any other costs. Okay. So now these are the composition of the costs. When you take purchase cost includes what? A lot of items. Purchase costs include number one, the purchase price itself. Number two, delivery or handling cost. Delivery or handling, transportation. Import duties, and then irrecoverable purchase tax. Any tax that you pay on this PPE that you cannot recover, and add it to it. Then let's trade discount or similar rebate. So that's the purchase cost. Then directly attributable costs also have a lot of issues. Directly attributable costs include what? One, installation cost. So installation cost. Two, testing. Electrical testing or testing, just testing. Three, so testing. Three, you can talk about professional fees. Professional fees. So professional fees talks about, example include what? Legal fees, architects, quantity surveyors, and consultants used in acquisition of what? The PPE. Then we move on to the next one. And the next one is any other costs incurred necessary to bring the asset to its what? Present condition or location. They are very stubborn. I have some three costs here. Number one is the dismantle cost. And I'll not treat it here, but there's a full video on dismantle cost. So it's among the lists. Can you watch that one and be free? Okay. Then number two is site restoration cost. site what? Restoration. We have site preparation. That will be directly attributable cost. That's a site preparation. Right. Site what? Preparation. But we also have site restoration. Then the last one is decontamination cost or environmental pollution. So decontamination cost or pollution. Now these three costs, they are a bit stubborn. So please kindly use that full video to get insight. Yes, it's part of the one that I sent you, the list. Good. There's a section called Dismantle Cost. So kindly watch that full video, or I will just add it to the video description section so that you can pick it from there. Now, we also have exclusion from PPE. Exclusion from where? PPE. The following items should not be part of the cost of PPE. So the following item, these ones are inclusion, composition of the cost. Now let's look at what? Exclusion. Exclusion. If you incur the following cost, do not add it to the cost of the PPE. Number one, general and administrative overhead should not be part of the cost of PPE as usual. Number two, so general admin overhead. Number two, initial operating losses should not be part. Initial operating what? Losses should not be part. Number three, pre-production cost. Pre-production cost. Pre-production cost should not be part. Pre-production cost. Then final one, number four, staff training cost. Now, staff training costs, it will not make the PPE ready for its intended use or sale, but it will be to make the staff ready to be used. So number four is staff training cost. Staff training cost. Now the staff training cost, it will not, the cost incurred training your staff on how to use the PPE. You bought some PPE, your staff, you have to train them on how to use those PPEs. Now, that cost that you've incurred, it will not make the PPE ready to be used. No, it does not make the PPE ready. What if after the training, the machine is not working? What have you done? You've not done anything. So what I'm saying is this. That staff training cost, it will make the staff ready to use the machine, but instead not make the PPE ready to be used. And here we are not calculating cost of staff, we are calculating what cost of machine. So therefore it must be out. Then we say that pre-production cost. Maybe you bought some PPE, you bought a machine for baking pastries. So this machine that you bought, or a plant, so let's say you bought some plants, baking plants. Now when you come in, you bought some flour, margarine, and other few items that as soon as you land, you can start baking your pastries, then you are done. We are saying that the cost of the flour, the cost of the materials needed for baking should not be part of the plant cost. Even though you bought them at the same time, though, they should be different. That's what we call it what? Pre-production cost. Okay, so that is it. We are done with the initial measurement. So I'll just come through some few questions for us to update ourselves on the questions. So that is it. But like I said, to complete it fully, kindly watch the video for that of the dismantle cost. That one, I think, just one video on it, and then we solve a lot of questions. So let's quickly go to the material to solve some few questions in it. Few questions. I'll scan through some few questions and then come back again to treat subsequent measurement fully, and probably we are done with the IA 16. So for all the standard, the one that have a lot of issues is the IA 16. So as soon as we are done with the IA 16, the rest will be touch and go, touch and go, touch and go, touch and go. Oh, okay. So I've even opened the inclusion from cost. So you do have all of this in here. Okay. Kindly watch the dismantle cost, the video on the dismantle cost to be fine. Okay, so let's go to some few questions. So let's see. You have, let's read the requirement required. What is the cost of the asset to be initially recognized in the PPE register? And what amount should be charged in the income statement relating to what the consumption of what the economic benefits? So here they're just talking about the cost and then depreciation. The consumption of economic benefit is what? Depreciation. That is the consumption of economic benefit. Good. Now they say we should find for the cost. So what is the initial cost? So here you have just been appointed as what? The financial accountant of Asuna Company. On January 1st, 2014, Asuna Company acquired a production equipment with a list price of 250,000. So the list price the same as what? Purchase price, quoted price, and base price. So probably let's look at the cost of the machine. It was production equipment. So cost of equipment. Let's go to the board. So solution. All right, here cost of what? Equipment. So first, I'll put a CD sign here. We have the list price to be 250,000. Then I'll move on to the next one. The next one is the following further costs were incurred. Delivery, 18,000. Yes. Delivery, yes, must be part. So let's go and add it. Delivery, 18,000. The next one on the list, installation cost, 24,000. Yes, it must be part. Installation cost 24,000. So installation cost 24,000. Then the next one, general administrative or administration costs of an indirect nature, 3,000. Will it be part? So admin cost will not be part. Good. What if it is direct nature? Once it's an admin overhead, all the other costs are what? Indirect costs. So therefore, it will not form part. Once it's an admin or the distribution, it should not be part of it. So I'll not bring this. However, where do you treat all the exclusion? All the exclusion must go to where? The profit and loss as what? Operating cost. That is it. All the exclusion. Exclusion does not mean throw it away. No. Don't bring it here. Do not include it in the cost, but instead expense it as when you incur them. That is exclusion. So the next one, let's read the footnote. It says that the installation and setting up took sorry. The installation and setting up period took 3 months, and a further amount of 21,000 cedis was spent on cost directly related to bringing the asset to its working condition. Should it be part? Yeah. So to make the asset ready for its intended use. So therefore, it should be part. Just like you call it additional installation cost. Additional installation what cost. So additional installation cost of 21,000. Additional installation cost of 21,000. Additional installation cost of 21,000. Now, the equipment was ready for use on 1st April 2014. Now, it means that they acquired the land or the equipment when January, but it was ready for use in 1st April. So depreciation must start from 1st April. So if you're calculating depreciation for 2014, start from where? 1st April, because depreciation must start when the asset is what? Available. When the asset is available or ready for use, or when the asset is what? Completed. That is all. Not when the asset is being brought to use. So we have what we call brought to use, where they started using the asset. No. Because start depreciating it when the asset is available. That is it. Now, monthly managerial reports indicated that for the first 5 months, the production unit from this equipment resulted in an initial operating loss of what? 15,000 cedis because of small quantity produced. So here, 15,000 initial operating loss. Should it be part? No, don't touch it. It must be expense written off in a P&L. Okay, so the months thereafter show much more positive result. That's good news. The equipment has an estimated useful life of 10 years. That's for the depreciation calculation. An estimated useful life of 10 years. An estimated residual value of 18,000. Estimated dismantle cost amount to what? 12,000. So here I'll bring the dismantle cost. Now dismantle cost, we have to find the present value and unwind the discount accordingly. So if we go through the video that I asked, in fact, it will explain everything to you. But here, there's no cost of capital to look for the present value. Then we can, so therefore we can include it at what? The 12,000. So dismantle cost, estimated dismantle cost, which is, so the dismantle cost happens to be 12,000. So this is the total cost of the asset initially to be included in the PPE register. Okay, so if we should put all of them together, that's the total cost of the asset initially. Put all of them together and get something like 325,000 series. That's the total cost of what? The equipment. Then the consumption of economic benefits, that's the depreciation. The depreciation will be as follows. Now, I'll take the 325. They give us some scrap value. I'll less it and divide it by the number of what? Years. Now, for the first year, I'll multiply by the number of what? Months that if you used the equipment. Because the equipment was available already or completed on 1st April 2014. For the scrap value is what? 18,000. Useful life is 10 years. But for the first year to be 9 months, because from 1st April to 31st December, how many months? 9. So that's the consumption of economic benefits. So therefore, we have something like this. Less 18,000 or divided by 10 years. Now times what? 9 out of 12. So that will be the depreciation charge for the first year. We are done with this particular question. The rest, as you see the format, I'll just be scanning through and quickly complete the subsequent measurement to have enough time to solve questions. So I'll go to Dumfo Limited. I'll go to Dumfo Limited. Okay. Now let's solve this particular question. Samampa Limited. So Samampa Limited acquired a machine under the following terms. So manufacturer's base price. So let's go to the board. So cost of what? Machine. So we are looking at the cost of machine. Right after this question, I'll move on to subsequent measurements. And then we are getting to the tail end of what? IAS 16. And probably we'll add IAS 40 to it. Okay. So here is machine, right? So should be cost of machine. So cost of machine. Cost of machine. So let's look at the cost of this machine. It said that manufacturer's base price is 50,000. Okay, so that's 1,050,000. That will come. So that's the base price. So base price. That's 1,050,000. Must be part. Then the next one is trade discount. Yes, we say less what trade discount applying to the base price only. So 20%. So find 20% of 1050 for me. So 20%. So less trade discount. Trade discount. So that would be 20% times what 1050,000. And that will give us 240,000 average. Or 210. Should be 210. We take it off. So the net amount is what? 840,000. That's the payable amount. That's the amount that will be paid. The next item on the list is what? Early settlement discount. Taking on the payable amount of the base cost only, 5%. Now, we don't bring in settlement discount. So settlement discount should be what? Ignored. It rather, we net it off in the operating cost. So be treated in what? In the P&L through the operating cost. So that is the settlement discount. What we are interested in is the trade discount. So take note of that. Settlement discount given to those who pay on time, prompt payment. And then the trade discount is for those who purchase more. We also call it bulk discount. It's like buy 3, get 1 for free. Yes, that's the trade discount. The next item on the list is what? Freight charges. So freight charges is 30,000. So let's go and then put it in. So freight charges. 30,000. The next on the list. Import duties, 20,000. Import duties, 20,326, right? 20,326. So import duties will be the import duties. 20,326. Electrical installations will be parts. Electrical installation cost 28,000. Yes, must be parts. So electrical installation. Electrical installation. which is what? Which is 28,000. The next item on the list, quickly. Staff training cost. Should it be part? No, it must be expense. Staff training cost, use of the machine should be expense. Then pre-production testing should be part. Any idea? Now, pre-production testing should be part. Why? Because this is testing. What we don't like is pre-production cost. So here we intentionally remove the cost and put testing there. So if it be pre-production cost, that one should not be part. It must be excluded. But this is testing. So pre-production testing should be part of cost of the PPE. So that's testing 22,000. So testing. So testing is what? Pre-production. 22,000. Let's continue the game. Good. So this is pre-production testing, not pre-production cost. Legal and professional fees. Should it be part? 30,000. Yes, must be part. Legal and what? Professional fee. Okay. So legal and professional fee, 30,000. It must be part. Legal and professional fee, 30,000 should be part. The next item on the list is purchase of a 3-year maintenance contract. Should it be part? Purchase of 3-year maintenance contract? No, this should not be part. It must be expense in the P&L. Estimated residual value. Should it be part? No. Estimated residual value we use to calculate what? The depreciation, so it should not be part. Then the next one is the machine will cause an environmental pollution, which will be restored at a cost of 80,000 at the end of the useful life of the machine after 5 years' time. The cost of capital is 10%. So this is what? Environmental pollution or decontamination. So we need to make a provision for it. So here, to get the cost of the machine, find the present value of the environmental pollution. That's the restoration of the environment to its what? Safe condition. So the actual cost is what? 80,000. Cost of capital is 10%. I don't know what? Year 5. I don't know year 5. At the end of year 5. So here, let's find the present value of the environmental pollution. The restoration cost, we call it provision for environmental pollution. Let's calculate the present value. Let's calculate the present value. I'll do the present value here. And the present value is equal to the future value of 80,000 divided by 1 plus the cost of capital 0.1 to the power 5. Here's what you get. So that will give us about 49,674. So 49,674. Now put all the costs together and now let's get a total cost of this machine. And depreciation will be based on that figure. And don't forget to still watch the video on the dismantle cost fully. Okay. Great. So total cost is equal to overall cost. Let me write it here. 1,020,000. That's it. 1,020,000. Depreciation based on it, and then the rest continue like that. Okay. So I'm done with the initial measurement, but I cannot end it without letting you try some. So there'll be some question on the screen. You have just 3 minutes to work on that for me. Kindly pause the video and work on it for solving. Great. So start work. We do have just 3 minutes to finish up. For 3 minutes, plenty. 2 minutes too. Right after reading through now, kindly test me your final answer. So you can just use your calculator. Also, when you're going to just be adding them. When you get the last one, sum it up for me. We are done. Now let's solve it together. I hope you pause the video. Okay, so now I just have to take those that supposed to be part and those that should not be part. That's all. First, so where's my calculator? As I went going down, just be adding it. So first, feasibility study. Now, it should not be part. That's all. Feasibility study should not be part. So it should not be part. Okay, so architect fee, yes, it must be part. That's the professional fees, legal consultant use. Okay, so that one should be part. Okay. The next item is site clearance by external demolition professionals. That's 80,000. It should be part. 80,000 should be part. 80,000 should be part. Perfect. Then construction materials. That's 600,000 should be part. Great. Construction materials 600,000 should be part. The next one is cost of own inventory used in construction. Their cost is 30,000. Meanwhile, the NRV is what? 24,000. So which one do you use? Yes, it must be part, but you have to use the NRV, right? Perfect. You have to use the 24,000. I like that. So therefore, if I should end here, 180, 624, not the 30. Great. Let's continue. Internal construction staff salary during the period of construction. Yes, it must be part. So you add it. External contractor cost. External contractor cost. That is what? 360. That must be part. Perfect. Then income from renting out. So this 2,400 should be part of, yes, should be part. It should be part. Should be part. It should be part. Okay, so there's a question here for us. Let me pick the question up. Okay. So we're changing figures then. Let's see. So it should be parts. That's great. Now the last one says income from renting out part of the site as storage depot during the early phase of the construction. 12,000. They less it. No, this is other income, so it should not be part at all. So it shouldn't form part of the cost. Don't less it. So that's all. So therefore, the cost of this asset should be 100 plus 80 plus 600 plus 24 plus 360 plus 2,400. That should give us my calculator was giving me 3510 or so. Is that correct? My calculator was giving me 35. That's so. Because I just picked their total of 3,500. So 3,566. Then I added back the 12,000 that is subtracted. I had 3,578. Then I subtracted the feasibility study of 8 from it. I had 3,570. Then again, there was a written down of the inventory. So I less 6. Okay, so it should be 3,564. Yeah, correct. 3,564. Perfect. So that is the end of this particular question. That is the end of this particular question. That's the end of this particular question. Okay, so as we have demarcated this section for question solving, I'll project the last question for the day. Then I'll move on to. Okay, so kindly try this one for me just within 2 minutes. 5 marks. 5 marks. Start work. So I'll go straight to the point. And then explain and quantify how the oil platform should be treated in the financial statement. They say financial statement. So they need P&L and what? The financial position. Now this is dismantle cost or cost of site restoration or decontamination cost. So let's quickly provide the entries. They are saying that on January 2012, Western Oil Company acquired a new constructed oil platform at a cost of 300 million, together with a right to extract oil from Cape 4 Point offshore oil field under the government of Ghana license. The terms of the license were that, the terms of the license are that Western Oil will have to remove the platform, which will then have no value. So scrap value is 0, and restore the seabed to an environmentally satisfactory condition in 10 years' time when the oil reserves have been exhausted. The estimated cost of this on 31 December 2012 will be 150,000 million. The present value of one city receivable in 10 years' time at the appropriate discount rate for Western Oil of 8% is 0.46 cities. That is all. So all what you have to do is, first of all, the present value, the asset should be stated at the cost plus what? The dismantle cost. plus the dismantle cost. So all what we have to do is this. First, they say we should prepare the extract. What goes to the financial statement? And what goes to the individual financial statement we have. So I'll start Western Oil. Western Oil Limited. Let's take P&L for the shorts. Into bracket 2012. They are requesting for 2012. Please, the question, there was a date in dated December. That date should be January, not December. Then I'll put financial position here, the balance sheet, what happened there? 2012. Ghana city in million, right? City in million, that's the reporting currency. What goes in there? That is what we are looking for. Okay. So first, I have to calculate the cost of the oil platform. The cost of the oil platform that they acquired. First purchase cost is what? 300 million. So it must be 300 million. Second, dismantle, removal, and restoration of what? The environment to restoration of the environment to a safe condition. What is the cost? So the purchase cost is 300 million. That is another dismantle cost. It's 150 million. Find the present value. What is the present value? Now the examiner has given us cost of capital in the question, the discount factor. Anytime the examiner give you this particular discount factor, then it means that examiner does not want decimal. I can't use it as such. So let's use it. First open the bracket, the 150 million times 0.46. What is the answer? So the answer will be, so 0.46, that's 69 million. Wow. So immediately, 69 million. So therefore, the cost of the asset will be 369. Depreciation. Depreciation.
It is gone back.
So basically, depreciation based on what? 369 divided by 10, right? Now probably give us 36.9. 36.9. That is a depreciation charge. 36.9. Or we should raise 3 zeros, right? Probably let's raise 3 zeros to be on the safer side of. If you are working in 3 zeros. So let's work in 3 zeros in thousands. So it'll be 36,900. I'm adding 3 zeros to it. So that'll be on surface side of. So first depreciation go to P&L. Depreciation is 36,900. Then immediately you calculate what you call unwind of the discount, finance cost. So the present value of the dismantle cost just multiplied by the cost of capital to get what? The unwinding of what? Discounts. If you watch the video, we explain the full meaning of that. So kindly do that for me. So call here dismantle cost. We call it finance cost. We charge it to what? Finance cost. Into bracket the dismantle cost. Open your bracket. Tell the examiner that it is the present value that we calculated. It is the present value that we calculated. That is 69,000 times the cost of capital. What is the cost of capital for this question? The cost of capital happened to be 8%. Okay, so 8%. So times 8%. Please, what do you get? So that would be 69. If my calculator will be correct, so 69, 1, 2, 3 times 0.08, that'll give us 5520, right? So 5520. Okay, so we are done with the P&L. Go to the financial position for 2012. The ending of the first year. All what you have to do is first write the cost of the assets. So oil platform, cost of the assets, brackets, oil platform. The cost happened to be what? 369,000 less depreciation. Depreciation happened to be 36,900. Whatever answer you get, that is the carrying amount. Whatever answer you get, that is the carrying amount. The next one, all what you have to do is you then go to what we call non-current liability and tell the examiner that we have to make a provision. So provision for environmental pollution. Open your bracket nicely. Tell the examiner that it is the present value, this particular figure, which is 69,000 plus the unwind of the discount, 5520. So putting all this together, we have 74,520. So that is the end of the game. So doing this for what? 5 solid marks. That is all. Or you can explain to us. I am done with the initial measurement. Let me go to subsequent measurement to end the game. In fact, I'll finish IAS 16 today. IAS 16 must go down today. So IAS 16, let's go to the subsequent measurement. So subsequent measurement. Oh, sorry. But no, you're supposed to start cleaning from the top. Let's go to the subsequent measurement of PPE. Let me see. There's a question here for you to get the. Sorry for doing that. Now let's look at the subsequent measurement of PPE. So subsequent measurement. Of PPE. Please, no shortcut in exam. Okay, so subsequent measurement of PPE. Yeah, the standard is saying that subsequently, after the initial recognition, how do you measure the PPE? So like for instance, this oil platform that the company acquired in January 2012. January 2012. As at December 2012, what should be the value? December 2013, what should be the value? So the initial measurement is what we did, what we calculated at cost. So the word subsequent measurement simple means measurement after the initial what? Recognition. So the subsequent one, the next reporting period, the next one, in that order. Great. So that is it. Okay. Now the standard is saying that the entity should select or to choose between two models. So we have models that we have to use. We have the cost model and what? Revaluation model. So I'll pick them one after the other. Revaluation model. Revaluation model. So let's talk about the cost model in summary, revaluation model in summary. Then the rest is question stuff. So cost model, all of them, they're looking for one item. They're looking for what you call the carrying amount. All the models, they're looking for what? Carrying amount, which the same as what? The current value or the value to be placed on the asset. All the models, including, in fact, all the measurement bases, they're looking for what? Carrying value, all measurement bases. So cost model will give us a particular formula or a particular way to determine what? That of the carrying amount. And then the revaluation model too will determine or will give us a different method or approach to determine the carrying amount. That is it. So let's see. Under the cost model, the carrying amount is equal to, is a relax. Get the cost of the assets, which start from the initial cost plus any capitalized cost up to date. Thank you. Plus any capitalized cost up to date. So these two, add them together. Less accumulated depreciation. Less accumulated what? Impairment. Impairment loss. Accumulated impairment loss. Okay. And that is the formula that we are going to use to determine the carrying amount of an asset. Now, I'll cut off this section. Why? Because there's a full standard that talks about it. That's impairment, IAS 36. IAS 36. So for now, let us concentrate on what? Cost and accumulated depreciation. So that when we go to IAS 36, we now complete the formula well. When we go to IAS 36, we will now be subtracting the impairments. For now, let's subtract the depreciation. We are done. So basically, that is it. Now, let's move on. Now, you get the costs. Now, what we have to look at it is the accumulated depreciation. What we have to look at it into detail is the accumulated depreciation. So I just write the method of charging depreciation with their various formulas there. Then we move on with the game. As what? Summary. Good. If you want to get the detail, can you use the video? If you want to get the detail explanation, can you use the video? Now, it means that the asset should be depreciated. So depreciation. Depreciation. I will tell you for value of what? The assets. Depreciation simple means systematic allocation of what? The depreciable amount over the asset useful life. We have the methods. You know the methods. Number 1, up to 5. We have what you call the straight line method. 2, we have the reducing balance. So we should know how to calculate depreciation using what? The straight line. Straight line is equal to the cost of the asset less the scrap value all over number of years. That is the straight line method. Okay, so that's the straight line method. Reducing balance is equal to the carrying amount. That's the cost minus accumulated depreciation, right? Minus accumulated depreciation times the rate. That is it. Let's go to number 3. These are the main important ones that you should know. The first two. Sum of years digits. And then number 4, we have what you call production unit method. Production units. Number 5 is machine hours, using machine hours. So these are the depreciation methods. The first two are very important, but the 4 and 5, they are just remix of the straight line. Remix of the straight line. So kindly use the video where a detailed calculation has been dealt with. So that is it. So you calculate the depreciation and then you accumulate it over the period before you subtract it. Accumulated depreciation simple means you adding all the previous year's depreciation up to the date of what valuation or measurement. We are done with that of the cost model. The rest is what question solving. Don't forget it's a summary. Okay, so let's go to revaluation model. The revaluation model. Revaluation model. So method 2. Revaluation model. Don't forget that all of them are looking for what? Only one figure, carrying amount. Yes. So that's the alternative. Probably you can travel by what? By land, by sea, or by air. What matters is you have reached your destination safely. So that's the same way we have here. Okay, so under the revaluation model, the current amount is equal to CA. Chartered accountant, come again. Is equal to here the revalued amount, which is the same as fair value, which is the same as what? Fair value, less subsequent, I like the term, subsequent accumulated depreciation minus subsequent accumulated impairment loss. That is it. So how is this different from the cost model? The cost model, we pick the cost less the accumulated depreciation and less the accumulated impairment loss. But over here, we are lessing subsequent. I will explain why we use the word subsequent in our next calculations. Our next set of calculation that we do. I will explain the word why we use the subsequent. Again, once there's impairment, I'll not treat impairment here, because impairment is on its own and the IAS 36. So let me cut this section off. So if I cut this section off, so therefore we have to concentrate on what? Revalued amount less subsequent accumulated depreciation for now. That is the limit of the IAS 16. IAS 36 will give us the impairment. So now let's explain this. Revaluation simple means we want to match or compare the book values of our PPEs to that of what the market value. You have to compare or match the book value. That is the issue. So what is revalued amount or the market value or the fair value? You should know the definition of fair value. Fair value simple means an amount at which we will receive to sell an asset. The amount which we will receive to sell an asset or pay to settle a liability or transfer a liability between market participants in an orderly transaction at the measurement date. So that is it. That is the fair value. It simply means the market value or the fair or the going rate of that particular asset. So currently on the market, what is the price? What is the value? That is it. And that price must be fair because it must be a price between what? Market participant, not related party. Not the market between parent company and subsidiary company. Not main company and sister company. No, not that. That's not fair value. Then subsequent, I'll explain the subsequent probably in question. It will pop up. So stay connected. I'll remind you when I'm solving the question. Good. Now, if you select the revaluation model, the standard gives some 3 conditions that you have to follow, like rule. The revaluation model is highly subjective and it can lead to what? Manipulation of account and the window dressing. It's area that accountants can use to what? Manipulate the account. So because of that, they have to key in a lot of conditions, a lot of rules, a lot of principles so that you can abide by it to reduce what? Any manipulation. Good. So rule number 1, it says that the valuation must be what? Performed by a qualified independent valuer. Qualified independent what? Valuer. That is all. Qualified independent valuer. And must be a professional. So please, the accountant cannot revalue PPE, please. Accountant, Mr. Accountant, you cannot revalue PPE. Why? You don't have any professional, I'll not even say qualification, professional skills to revalue assets. You are not an engineer or quantity surveyor. No, you are not a mechanic to determine that, oh, this vehicle, the fair value is 24,000. No, please. Please. So those accountants that are doing that, stop. The standard say what? Stop. Okay, so that's the first point. Professional and then independent. Independent, that means the organization should not connive with the valuer. That's the point 1. Point 2, if a particular asset is being revalued, the entire class must be revalued. You know, the assets are in classes, right? So we have those that look like a building and land. Those that look like what? Vehicle, computers. So let us know you have 5 trucks, 5 heavy duty trucks. But 3 of them are in good shape. And then 2 of them are in terrible shape, very bad. To the extent that if you decide to revalue all the 5, because of the 2 bad, it will even spoil the good name of what? The 3. So you decided to revalue only 3 and leave this. You say no. Even if you revalue just 1 truck, you revalue just 1 of the truck, can you revalue all the entire 5 trucks that you have? Good. So that will be like subjective. You've been somewhere biased. You select the good ones and do the evaluation to change things in the books, right? No, not agree. So that is it. So that's the second point. If a particular asset is being revalued, the entire class must be revalued. Then point 3 talks about the valuation must be performed periodically. So period by period. So if your period is every year, at the end of every reporting period, if you have to reevaluate at the end of what every reporting period, maybe at the start of every year, go by it. Maybe at the middle of every year, you do that. So let it be period at a regular interval. Not that you sit down and when things are looking bad, when things are going down, then you decided to do revaluation to change things. No, we will not allow it. Mr. Accountant will not allow you to do that. So that's what the standard is saying, because here is highly subjective. So take note. We are done. Anytime you perform revaluation, 2 things will happen. Either you gain or you lose. Yes, because you are comparing what? The book value to that of what? The market value. The book value is called carrying amount. The market value is called fair value. So you compare these two. So definitely there will be some either gain or loss. How do you calculate this gain or loss? How do you treat it? So I'll scan through the accounting treatment and pick those ones. When you're solving questions on them, then you'll be fine. Now, we call it revaluation gain or loss. Calculation of revaluation gain or loss. You compare two items as I wrote them down. Is the fair value of the assets or the revalued amount, fair value or revalued amount. Please, they are the same. All these are the same. So much less the carrying amount at the date of what? Valuation. Please, at the date of where? Valuation. So this becomes, if the fair value is more than the carrying amount, then it's what? Again, the reverse is loss. So this becomes revaluation gain or loss. That's all. We are done calculating. Now let's look at the accounting treatment. This is where very important, the treatment of the revaluation loss or the gain. Please take note. Right after the treatment, we look at the last aspect of IAS 16. Then probably that's all for IAS 16. The rest is what question solving. So now the revaluation gain or loss, how do you treat it? Let's quickly look at that one too. So accounting treatment of revaluation gain or loss. So accounting treatment. Let's start with revaluation gain. I believe we can find carrying amount, right? So let's assume that the asset fair value, so fair value is, let's say, 25. Carrying amount is what? Let's say 12. What's the revaluation gain? So there's revaluation gain of what? 13 million. So the question is, how do you treat this 13 million in the books? That is accounting treatment. The standard is saying that relax. First, all of them have two treatments. So treatment number one and treatment number two, you know, the double entry, debit and credit, right? Thank you. So the first treatment is that add the gain to the carrying amount of the assets. Simple means simple, in simplest term, debit the asset, that's all, with the gain. That's the simplest term. Debit what? The asset with the gain. Let's go to point 2. I wish I can write the debit in purple, small one. Debit what? The assets. So debit the asset. To back at the carrying amount too. Carrying amount. Point number 2 is A. Then you add it to OCI, or you credit what? OCI. So credit other comprehensive income, which is the same as what? Revaluation what? The same as revaluation surplus account. Into bracket, you are adding. It means that add it to OCI. Thank you. That's the meaning of this statement. That's A. So debit and what? Credit. There's an exception to this basic rule. So except for, so B, treatment number B, except the exception affects only that of the A. But before I go to the exception, let's do the estimate. So the same question. This is what we are talking about. in your P&L, you know that P&L from sales revenue up to profit after tax is the P&L. Then there's other comprehensive income. So under it, under the other comprehensive income, that is where we have what? We have the revaluation gain, right? Revaluation gain of what? 13. That is it. If I don't see the OCI, I don't mind you. Okay. Because from sales revenue up to profit after tax is the P&L and is the OCI. Okay. Now let's continue the game. Then in the financial position, we said that the asset value becomes what? Just record so the assets, maybe building. The value, just add the current amount was 12 plus 13, making what? 25. That is all. We are now with the first treatment where there's no exception. So this is how we treat it. Add the gain to the current amount of the asset. We've done that. Send the gain to OCI. We've done that. Now, what if there was a tax? I'll add a tax to it. That's a deferred tax on revaluation. Add it to it. Now, what happened is this. What if there was a previous loss? So, except where there is what? Previous loss. Previous loss. That's all. So in situations where there was previous loss, you cannot send the entire 13 to the what? The OCI. The OCI. So let's assume that this particular person, the previous year, they did revaluation and they had a loss of, let's say, 7,000. Now, the loss of the 7,000 they had, revaluation loss of 7 million. This 7, wherever that 7 is, we have to clear the 7 before we can record any figure in the OCI. So in short, last year you did revaluation, you had a loss of 7. This year you did the same valuation, you've made a gain of 13. You cannot lie to yourself that so far the asset has reported a total gain of 13. No, it's a lie. Last year the same asset brought loss to you. So why can't you net them off and get a net of what? Gain. Wherever this gain is, a portion of this 13 should be released to go and cancel it. And this 7 is sitting there, P&L. So the revaluation loss is sitting nicely in where? The P&L. The revaluation loss is sitting nicely in what? The P&L. So you go to the P&L and cancel it. So here, look at where we are going to record it. So I come here and record it here. Everything here. I write here revaluation what? Gain into bracket reversal. It is reversing what? The previous loss of 7. So I'll put the gain here, 7. So what's the total gain? 13. 7 has been released to the income statement to offset the loss. Now left with how much? The difference. So left with 6. So now left with 6 million. That's 13 minus 7. Agreed. So now left with 6 million. So that's the 6 that we can record. However, take note that the exception affects only the second treatment, does not affect the first treatment. That's all. Now, what if this loss, the previous loss, happened to be 15? The loss happened to be 15. Then that means, in fact, we cannot even reverse all. We had a gain of 13, but previous loss of 15. So what happened is this. We have to now reverse only to the tune of today's gain. And nothing goes to where? The OCI. Nothing goes to OCI because we are not able to offset what? The higher loss that took place last year. We are done. Now let's go to revaluation loss. I will explain some few items there to end the game. Let's go to revaluation loss. So going, you see me holding the duster now, that means I'm going to clean it too. Going. Okay, so gone. Now, revaluation loss, accounting treatment of revaluation loss. That one to 1 and then 2. A and what B, that's all. The B will be in if there's what exception. If there's exception. So let me put exception here. I'll be getting. So you can fill in the space for me. Except in situations. Let's assume that the fair value is 30. Current amount is 45. So therefore there's a revaluation loss of what? 15. The fair value will give you free of charge. Current amount, you said that it cost minus what? Accumulated depreciation. Now how do you treat this 15 in your books? So the accounting treatment of this 15 in your books. First, credit the assets. So credit your assets into bracket the carrying amount. It simply means subtract from the carrying amount. That's the credit. So subtract this loss from where? The carrying amount of 45. It will probably give you the 30. Probably give you the 30. That's all. Second, but add to your operating cost. So it's operating expenses. So debit your P&L. In simple means add it to your operating expenses. So revaluation loss is added to operating expenses in short. Or revaluation loss match the expense in the year that incurred them. Now, except for situation where there was what? Except for situation where there was previous gain, as usual, yes. Previous what? Gain. So let's also assume so let's provide some P&L illustration. Let's assume that your P&L is like this. The record revaluation was loss of 15. You go to your balance sheet, financial position, the asset value. You open a bracket, current amount of 45 minus 15, you get to 30. You are done. That's the treatment. That's the 1 and 2A. But let's assume that last year there was a revaluation gain of, let's say, 7. This revaluation gain of 7, where did you record it? Where did you record it? So it was recorded in what? OCI. Good. So wherever this gain is, a portion of today's loss must be released. So today's loss is 15. This gain was recorded in where? OCI. So let's go to OCI. So I'll come here, write OCI. And then I'll tell the examiner that revaluation loss into bracket reversal, which is what? 7. I'll put in bracket. Then what left? Left with what? 8. Now the 8 go to the P&L as what? Revaluation loss. Good. So that is it. So until the gain is cleared, no figure enter the OCI or no figure enter the P&L as a loss. On that note, we are done with the revaluation. Left with the last two aspects that I'll summarize it. Then IAS 16 is gone. One left is what? Probably trial questions. Now I'm going to do subsequent expenditure incurred on the assets. All of these, they are illustrations in the manual. For instance, if you take the manual and go to illustration 7, the handout and go to illustration 7, you get the revaluation, the reverse. So from illustration 4 going, all of them are revaluation. So can you try them? They are with solutions, so you don't need to worry at all. Especially illustration 7 is the reverse. Good, the reverse. So take note of that. Now let's go to subsequent expenditure. Subsequent expenditure incurred on asset. Simple means the initial cost that you incur after you acquired every asset at the initial stage, you by all means incur additional cost on this asset. Yes, no matter what, you incur cost again. How do you treat this subsequent cost? We call it subsequent expenditure. Here, there are two of this. So there are two types of the subsequent expenditure. They are the expenditure that you incur after the acquisition. So if you buy the asset, as soon as you are done, if you buying items, maybe components, part, fuel, repairs, maintenance, other stuff. There are two types. We have one, the one that amounts to what? Revenue expenditure. So revenue nature. So revenue expenditure. Then we have what? Capitalized expenditure. Now the subsequent expenditure that amount to revenue, they are the expenditure that the subsequent expenditure, they are the one that help the organization to earn the stated benefit. So just maintain the even flow of what? The economic benefit. To maintain the even flow. So accounting treatment, it must be what? Expense or written off. It must be expense or written off in the year of what? Current. The year that you incur them, write them off. So revenue expenditure, just add it to operating expenses. This one, the benefit lasts within one financial year. The benefit lasts within one financial year. Example include what? Repairs, maintenance, fuel, and then minor overhaul. Good. Capital expenditure. They are the ones that add value. They are the ones that improve the assets. So any expenditure that improves the assets. So the one that improves the asset, that's all. That's the capital expenditure. Now, what's the accounting treatment? It must be capitalized. Capitalized means add it to the cost of the asset. So accounting treatment, capitalize it. Simple means add it to the cost of the asset. Add the expenditure that you incurred to the cost of the asset. For instance, if you have performed an upgrade of a machine, the upgrade cost is 2,000. Oh, add it to the cost of the machine. Maybe the initial cost of the machine is 20,000. So after the upgrade, now the overall cost will be 22,000. Okay, that's the accounting treatment. Now the standard provide situations that improvement will be allowed. So there are three situations that amount to improvement. How do you quantify the improvement? We are saying that you have improved the asset. One, if there has been a improvement in the following items. If the economic capacity has been enhanced or expanded capacity. If the economic capacity has been enhanced, economic capacity has been enhanced. Then the next one is if the life of the asset has been increased and then reduction in operating losses. reduction in operating losses. That's all. So if the only three expenditures or three items that amount to improvement, they are here. So even if one is there, improvement has taken place. That's all. Improvement has taken place. For instance, if you check this particular question, there's a question here called Samantha. There was an upgrade. Samantha illustration 12. Illustration 12. Okay. And this question is your own in advance. So illustration 12. They said that on January 1st, 2014, Samantha decided to upgrade the machine by adding new components at a cost of 200,000. This upgrade led to a reduction in production time per unit of the goods being manufactured and using the machine. The upgrade also increased the estimated remaining life of the asset. So the life has increased and has also what? Reduced what? Operating time, and it has also increased the capacity. So therefore, they can capitalize it. That's all. So we are done with the subsequent expenditure. I left the last item, then we are done for IAS 16. You know, we have the recognition. We also have what we call derecognition. Derecognition. For the disclosure requirements, we'll do that when you are doing publication, and then we just disclose it there for them. The last aspect is called derecognition. Then we are done. Derecognition of what? PPE. You know, we have point of birth and what? Point of what? Death. This is the ending part of the PPE. Now, the standard is saying that as soon as the economic benefits cease to flow to the entity, you have to also cease to recognize that as what? That PPE as an asset in your book. So when the future economic benefits cease to flow, when the economic benefits cease or stop flowing to the entity, you have to do what? Stop showing the assets as your asset. That's all. Then the question is, on what basis will the future economic benefits cease to flow? On what basis will the future economic benefits cease to flow? Let's look at some few. It's through disposal of the asset, through disposal, or the life of the asset has come to successful end. You say you're going to use the asset for 5 years. You are in the 5th year, December last year. Oh, then you have to stop recognizing the asset. Why? Because the life has come to a successful end. That is all. Now let's go to the disposal. When you talk about disposal, as stated in English dictionary, now disposal have simple means we are getting rid or we are just getting rid of what? The assets. We are getting rid of the assets. Simple means the following. 1, disposal. We have so many forms of disposing assets. Number 1, disposal by what? Sale. Disposal by sale. Disposal by what? Donation. Disposal by what? By destruction. By dumping. Some of the assets, no one wants it cheaper value. So definitely you have to dump it somewhere. We also have disposal by transfer. We also have disposal, yes, by transfer as like leases. That is all. Like leases. You owe some PPE, your office building. So he decided to lease the building out to a lessee. So it means that you have to stop showing the assets in your books, especially if you lease it out under what? Finance lease. Good. That is it. Okay. So that is it. Now let's go through disposal by sale. But for purpose of your exams, when examiner use the word disposal without any other description, he is referring to what? Disposal by sale for cash. So if you sell an asset for cash, what is the accounting treatment? And then that's the end of IAS 16, and that's the end of today's session. So the accounting treatment in disposal is as follows. I have only 3 steps, then you are done. Step number 1, probably you sold the asset for cash, right? For cash, so add the proceeds to your cash. Of course, take account of the cash because you receive money. Second, calculate the profit or loss on disposal. Profit or loss on what? Disposal. How do you calculate the profit or loss on disposal? To calculate the profit or loss on disposal, first, you need the proceeds is equal to the proceeds less the carrying amount of the asset at the date of what? Disposal. So proceeds so much. So we call it profit or loss on what? Disposal. Proceeds so much less what? Carrying amount. So you got what? Profit or loss. If it's a profit, add it to other income. If it's a loss, just add it to operating expenses. Then you are done. Then finally, here I normally call it remover, or I call it do that thing, because remove the details of the asset from the pool in a PPE schedule or the PPE register. Remove the details of the disposed asset, because if you have 5 vehicles and it's added to dispose of, let's say 3, then probably you should left with what? 2. That is also, that's a removal. So that one we do it cost from cost, accumulated depreciation from accumulated depreciation. That is it. So cost from cost and accumulated depreciation from where? Accumulated depreciation, and then that is the end of the game. Great. So fortunately for us, this is how far the good Lord will bring us. On that note, we will continue again when we meet. Great. The remover. The accounting treatment of the disposal, just add the proceeds. Second, calculate your profit or loss. Third, remove the details of the assets from the pool or from the general list, so that we can now report on what? The remaining assets. Okay, so that is that. How do we get it? No, it's not sales. You add it to the cash. So if you dispose of assets, the proceed is not sale, because sales is what? Sales is disposal of goods or services, what you deals in. So add the cash or add the proceed, whatever you receive. So the sales amount, the sales figure, so that the right word for it is the proceeds. We will not call it sales. So we call it proceed. Add it to your cash because you receive money. Because you receive money. How we get it? Yes. So that is that. Probably we might end here and continue again in our next meeting. Okay, so that is that. I will get it very well. And thank you very much for watching. See you in the next class. And kindly subscribe if you have not done that. Thank you. Have a nice day.